To the next section of the quantum trading course. So far we've gone through market structure. We've learned how to build a good solid foundation and understanding behind market structure, how to build that narrative, how to build a good multi-time frame analysis to understand and build intentions across all time frames to understand the direction of the market, where we can expect to see price head next, and look how we can get involved in trade ideas because we can understand where we could potentially see the market go next. Now we went through that in a good level of detail because, as we know, the most level of importance is structure, supply and demand, and then liquidity and confirmation. So the reason why we're doing liquidity after structure is because we use liquidity as a confluence to our supply and demand. So it would be good if we have a good understanding of liquidity first, and then we'll move on to supply and demand afterwards. So we've learned market structure to a solid good level. We've got a good base down, and hopefully you're all feeling confident with that. Make sure you have a really good understanding, and now what we're going to do is move on to the next thing, which is liquidity in the market. So we've got different examples here of different kinds of liquidity we have and the way that we see liquidity in the markets. We have trendline liquidity, equal highs and lows liquidity, and we have liquidity that is above each and every highs and lows. So what is liquidity first? Okay, liquidity are areas on the charts where we know that there are buy and sell orders placed in the market. We understand these are areas where retail stop losses are. We are still retail traders, even though, like I've said before, we talk and say that we are smart money traders, we trade like the banks, but we are still retail traders, okay? But we understand the majority of how retail trade. We understand retail methodology in the markets. So we understand if we know how they trade, we can potentially look to see where these retail traders stop losses are, okay? Now, what we use liquidity for is a confluence to see when retail traders are in their trades, and if we see these retail traders get taken out of the market, this can then give us an indication and give us confluence that price might go in our given direction. So for example, how many times in retail methodology do you hear them say, oh, I got stop hunted, but then price went in its given direction? You hear this so many times. Again, retail traders, getting angry because they are looking to long. The price comes and takes their stop losses out, and then it goes in their given direction. This is what we look for, right? Because we understand how retail traders trade. We look for these confluences of how they trade. We look for them to get taken out of the market, and then we use that as a confluence to us to then look to get involved in our trades. So what we can see here is the first kind of liquidity in the market that we look at, which is trendline liquidity. So what is trendline liquidity first? So if you've ever traded retail methodology before, you will have heard of trend lines. What do retail traders do when it comes to trend lines? They look to buy and sell these trend lines. So they can see here that, let's just say we have this trend line right here. We can see here that we're drawing on, and we have this 1, 2, and 3 touch. Okay, I'm just going to expand this out for a minute just so we can make it a little bit more easier to understand. We understand from a retail methodology perspective, we know that retail traders buy the trend lines, right? So we can see here that they have a 1, 2, and a 3 touch. So potentially, what might retail traders be looking for and happen to do next? They might be looking to buy the 4th touch maybe, if price comes back and touches the trend line. So we understand that this is how retail traders trade. So what will retail traders be doing at this current point in time? Well, they might be looking to buy this trend line, okay? This is a risk to reward tool, and they'll be looking to buy this trend line because they understand that when price comes and taps into here, they're looking to buy. But what if we just think about it, if we know that's what they're going to be looking for, what can we expect to see happen? So if we see price come back down here and potentially go past the trend line, okay, so anyone who's looking to buy this touch on the trend line, what does this mean? Well, they've been taken out of the market. But then what do retail traders look to do once these trend lines have been violated? They then look for a break and a retest. Okay, this is like simple methodology behind retail trading. So if we understand that the retail traders are looking to buy this trend line to look to take this up, and then we understand if it breaks the trend line and they're looking to buy the break and retest, if we can identify this trend line liquidity, and then we can understand when we've had a sweep of this liquidity and it stacks in confluence with our market structure, our story and our narrative and our entry, and it stacks with everything else within our trading, we know that when we see this sweep, what we might want to see happen, right? What we could see happen is this, where price will continue on in its bullish direction, because we can see we have bullish market structure. We can see higher low, higher high, higher low, higher high, higher low, higher high. We're then looking for what they'd say is a higher low before a higher high. That's just what we'd be looking for. But we can see here that when price breaks the trend line, we can understand they might turn around and say, oh, we've had a break of the trend line for the break and retest. But think now, both the people who are looking to buy the trend line, okay, When price pushes below here, anyone who's looking to buy this trend line has been taken out. Then anyone who's looking to sell this trend line to take this lower will then be taken out, because what do they do? What do they do? They push price up in the given direction. So this is where people who are trying to buy this trend line, you'll hear them go, oh, I got stop hunted, but then price went in my given direction. And then anyone who's looking to buy this break and retest is also going to get taken out. So retail traders have been caught out on the wrong side of the market, but it's still gone in their intended direction. And when we can see these retail traders being taken out of the market in confluence to our structure and supply and demand when we come to it, and when we've seen things such around our supply and demand with liquidity confluences as well, this stacks in our favor. So we just want to learn about how to identify these different kinds of liquidities in the market. So like I said, we had this bullish trendline liquidity. So we understand when we see these lows, we can see when we have this bullish market structure, we have these lows, right? As we say, when we have bullish market structure, we have protected lows within the market. Now, what happens is these lows, what happen is they stack and generate liquidity, because what is happening is people are buying this trend line, okay? So retail traders are buying, and buying. They're buying below these lows. So what is happening? There is a stack of orders being generated along here. So we can identify and draw this on with trendline liquidity. So when we see these lows that haven't been ran like this, we can draw a trend line like this to show that there is still liquidity behind and below these lows. So we draw these on the charts, and we understand and we draw this line, which we'll go into when we come into it later, that when we draw this trendline liquidity, we can see on the charts where there is retail stop losses, okay? And when we look at it for vice versa, and we look at it from the bearish example, we can see here that what we're doing, we've got lower high, lower low, lower high, lower low, lower high, lower low. Now what is happening here is we understand that the highs always remain protected. So we know that these highs, we're never getting run. So there is liquidity above these highs, okay, because they haven't been run yet. And what we can understand is that these highs have all got stop losses above here. So people, when prices come into this trend line, retail traders are selling. When then it comes for the third touch, retail traders are trying to sell, okay? So we understand that is how the retail traders are trying to get involved in this market. When they see trend lines like this, when they come and take for the fourth touch, what do we know they're trying to do? We understand retail traders are looking to sell this trend line, because that's what retail methodology suggests. So what can we look at as a confluence? So if we know that retail traders are looking to sell this trend line, but then we see price break the trend line, we understand that we can see that anyone looking to buy this trend line, retail traders would have been stopped out. But now what do we know? We understand now that once this trend line has broken, we can then expect to see retail look to break and retest it, okay? But what can we expect to see happen? If it lines up with our structural idea, our story, and our narrative, because obviously, like we said, structure is always king and number one. If we see a confluence to see retail traders get swept out of the market, and then it goes in a given direction, this is just a perfect stack of confluence with the rest of our overall trade idea, because we understand when we've got our story, when we see both people trying to sell this trend line get stopped out, and then anyone trying to break and retest this gets stopped out, we understand that all people have been taken out of the markets, essentially trying to buy and sell that specific trend line. So this is where the perfect stop hunt had happened, where retail traders trying to sell this trend line will get stop hunted, and then it'll go in their given direction. So this is perfect stacks of confluences for us, and that is how we understand trendline liquidity, where we see these stacked lows such as this, okay, where you have, let's say you have bullish market structure, you can see that the lows that haven't been ran generate this trendline liquidity here, and then we also understand that we have this bearish trendline liquidity when price is pushing lower, because these lows have not been ran. These highs have yet to be ran. So these are the different kinds of trendline liquidities that we can see in the market. Next, we're going to move on to equal highs and lows liquidity. So let's just think from a retail perspective first. What do you always hear, and what is a super common way that retail traders trade? Well, that is buying and selling double tops, triple tops, etc. So we call them equal highs and lows, because it doesn't have to be a double top or a triple top. What we understand that when we see this, let's just say this triple top right here, what are retail traders doing at this specific point? They're looking to sell the triple top in this example. So when price comes up, what are they doing? They understand that price is failing to push above this point. So we understand that people and retail traders try to sell these triple tops, okay? So what they expect price to do, that when price comes back up and tries to tap into this, tries to come and say for a fourth touch, they understand that what they're looking to do here is looking to sell, because price is failing to break above this point. So in the way that we trade, what can we think straight away? We know that there are retail traders trying to sell, and we know that there are retail traders with stop losses above this trend line, okay? So what do we know that we could be looking for? People are trying to sell this triple top, okay? So we understand from a retail perspective, we know that the stop losses are there. So what can we expect to see happen? We understand now that the retail traders are looking to sell, but what can we expect? If we see price break above here, okay, anyone who is trying to sell the triple top has just been taken out of the market, okay? Their stop loss has been taken. But then what do they look to see? Okay, well, this area that was once price couldn't push past it, what will they be looking for? Okay, potentially a break and a retest, because this is what retail methodology suggests. But once again, what do we look for and understand? Well, we understand that from a retail's perspective, we want to see retail traders get taken out of the market, and we see this liquidity confluence being swept and stacked in our favor. So if we now see price push up, sweep all the liquidity that is sat above these equal highs or triple tops, or like we call them, equal highs and lows. But if we see the liquidity being taken out, what can we then see? If it lines up with our structural idea and our story, and we see this sweep, this goes perfectly in our favor to say, right, okay, cool, now we could see price now go in its given direction. So anybody trying to sell this trend line is being stopped out of the market, and then price does go in their given direction. And then anybody who is trying to buy the break and retest also gets taken out because price did actually go in its given direction. So you can see how people who are trading retail methodology are getting taken out of the market from both sides. And we know when we see these different kinds of liquidities, we understand that when we see these, we know where the retail stop losses are, and we're just looking to see them get swept out of the market and taken out of the market and stacked in line with our confluences. So it's the same thing here. If we just move this out of the way just to make it a little bit more clear, we understand here now that below this trend line, or where these triple bottoms are, we know that there are retail stop losses sat below this point. People are looking to buy this trend line, okay? Because what does retail methodology suggest? When we have triple lows such as this, or these triple bottoms, etc., like this, we understand that retail are trying to buy this. What can we expect to see? We understand now that they will be looking to buy this, okay? But what can we use as a confluence in the way that we trade? We understand that price is looking to go up, okay, from their perspective. But if we see price sweep below that now, we understand that all the retail traders trying to looking to buy this triple bottoms are being taken out of the market. And then once again, what would they look to do? They might look to break and retest this. But we understand now from our perspective, if it lines up with our story, our narrative, and our entry criteria, and we see this sweep as a confluence, we could then essentially see this happen. So anyone looking to buy the triple bottoms are getting taken out of the market, and anybody who are looking to buy the break and retest also are getting taken out of the market. So this is how we draw and understand these. So when we see these sort of equal highs, these triple bottoms, triple tops, double bottoms, double tops, etc., we just draw this trend line to understand and identify that we can see these, okay? This is how I like to draw them, and we'll go into this in a second, exactly how I like to draw them. And then the final one that we have is highs and lows liquidity. So above and below every single high and low in the market, there is liquidity, okay? It can be swing structure, it can be any sort of high and low in the market has liquidity above and below it, okay? So on its own, this high has liquidity. Above it, this high has liquidity. This low has liquidity. This low has liquidity. And the reason we draw this trendline liquidity as well is we understand that, well, if we know that there's liquidity below this point, and this point, we know that there's liquidity resting above all these lows. So we can understand and draw a trend line to identify this. But we just got to understand, we don't use this one as much, but just understand and know that there is liquidity above every single high and low in the market, okay? So if we just look at this from a market structural perspective, now we're talking about liquidity. What we are saying here now is, if we look at this as a breaker structure, as we understand, we have a bullish breaker structure. This leaves behind a new protected low and a weak high. Now, when we say a weak high, what we are doing is we are targeting to take the liquidity above the weak high. So that is what we're looking for, and that is what we say. So when we have this weak high, what we are doing is we are looking to take the liquidity above the weak high, because that is our target. Now, there is still liquidity sat below the protected low, okay? So there's still liquidity below this protected low. And this is why when people say, we have to see liquidity be swept all the time, there's all this different liquidity. What you've got to understand is there's liquidity absolutely everywhere, right? You can't assume that a specific liquidity is going to be taken, because essentially we just use it as a confluence, okay? Structure is always number one, and structure is always king, okay? So there is still liquidity sat below this low, right, okay? But this doesn't have to be ran just yet, because why? Because it's a protected low. We understand that just because there's liquidity sat below this low, it is a protected area. Okay, we do not expect protected areas to get ran until they are and they are violated and we get a trend change. Now, what I will say is if we were to get another breaker structure such as this, okay, and we get another bullish breaker structure, this now leaves behind a new protected low in the market, okay, which would be this point right here. So if I drag this on here, okay, we get a new protected low. Sorry, no, that breaker structure here would leave behind this new protected low in the market, okay? So now we understand that we've got these swing points right here. So now this is something to jot down and remember, that once price has failed, so we get this bullish market structure, if price breaks bearish and breaks below this lower low and price gets a shift in a different direction, all these old protected lows then become liquidity points and become weak areas that we look to target. So when we come to management, we will understand that these old protected highs and lows then become liquidity and become weak. So these all become potential targets, because what happens is, in a structural idea, we understand that we expect price action to hold, okay? We expect the ranges, think of order flow, we expect, say, bullish ranges to hold, and the second that violates, we can now expect to see what were old, previous protected highs and lows now become ran, and then these now become liquidity targets, because they were, like we said, there's still liquidity sat below these lows, okay? But we understand that when it's protected, we do not expect that liquidity to get ran. But once now, for example, in a bullish trend, we then see price action break bearish, we understand now that we've had a trend change, and now all these old protected highs and lows, in this case lows, these then become future liquidity targets we can expect to get ran. Okay, so this once protected low is now weak. This once protected low is now weak, and we can target as partial targets when we come into management. These protected highs and lows become liquidity targets. So understand, just write down and jot down that old protected highs and lows then eventually become liquidity targets, and they then become weak, and we then target these old protected highs and lows once we sort of see the structural break right here and we get a trend change. So that is how we look at and understand it from that perspective with highs and lows. And the final thing that I just want to touch upon here now is how we draw liquidity. So there's two different kinds of ways we can draw liquidity, and how I like to map them, you can do it however way you please. So when we've still got liquidity that is available in the market, I like to draw it on with this trend line here, which is just a line which has an arrow at the end of it. This is to show me that when I draw this, I understand that this liquidity is still available. This is unswept liquidity that has yet to be taken, okay? But then what happens is, when I draw this liquidity and then I see that the liquidity has been taken and has been swept, I will then draw and identify it and change it to this, which is this liquidity taken, because now we understand that this liquidity that was once available has now been swept. So we can't call this valid liquidity, and we wouldn't want to leave it on the charts as available liquidity because there's no liquidity available. So we want to change it to this. So if we understood now, let's just say we drew on this liquidity, we understand here from this perspective, we have these triple tops. We understand now that there is liquidity available above these highs, right? So people are trying to sell this triple top or equal highs, right? So this is available liquidity, and we use this arrow because we understand that the liquidity is still there. But if price was to now do this, okay, break above and push below, this now is not available liquidity because we have swept the liquidity. So this is where now I would change this to use this trend line one, because we can see now that we have taken the liquidity above the highs. There is no longer liquidity above these highs, so that is when we change it to this one. So we understand that when the liquidity is still available, we will use this one here, and then when the liquidity has been taken, this is when we will go ahead and use this liquidity taken. So what I want to do now is just show you and understand how we identify this liquidity is valid and when liquidity is not valid. Right, okay, so I want to just talk about quickly how to correctly draw and identify correct trendline liquidity. Okay, so we can see here on the left hand side, I've drawn on valid liquidity on the left with a trend line. Now on the right hand side, this liquidity is invalid liquidity. We can see here that I've left the label on to say this is valid available liquidity and this is valid available liquidity. But this, I've drawn that line, but think to yourself first, I'm not going to tell you the answer just now, just have a minute, pause the video maybe, and just try and understand why this is valid liquidity, why this is valid liquidity, but this is not valid available liquidity, and this one isn't, right? Just have a quick think, pause the video, and just try and think, and then I'll come and tell you the answer. So if you've had a chance to just have a think about it, think of it from this perspective. We have drawn on this bullish trend line that we've got, or this bullish market structure. Higher high, higher low, higher high, higher low, higher high. We understand that these protected lows have liquidity below them, right? So we understand that we can draw this on as valid trendline liquidity, which we understood in the last video. So what's the difference between this one here and this one here? The only difference is that the trend line is on this side instead of this side, okay? So why is this one valid and this one isn't? And it's really important to understand where your actual true available liquidity is in the market, okay? Because think, this low has not been ran. Okay, we've put in a new higher high, we pull back. In a bullish market, what is the expectation of price? To come and put in a new higher high in the market, okay? So we've come and taken the new higher high and put in a new higher high. So how can I draw a trend line and say that there's available liquidity above this high? We can't, because the liquidity has been taken above this high. So when we've come in and put a new higher high, we've taken the liquidity above the high here. So we cannot draw a trend line to say that there is available liquidity above this high, because this high has ran the previous high. So you can see, if we were to draw on a break of structure, because we understand, like we explained before, when we get a break of structure, we are targeting the weak high, and we're targeting to take the liquidity above the previous weak high. So when we draw this on as a target as the weak high, for example, and a protected low, okay, we understand now that what do we expect? We expect to see the liquidity above the weak high get taken. So when now prices come in and put in a new higher high, we cannot draw a trend line like this, okay, as available liquidity, because this is not available liquidity, because the liquidity has already been taken from these highs. We can see we've got this high, we've pulled back, and this high has swept the liquidity from that high. So we cannot draw a trend line like this, because price and the liquidity above them highs have already been taken. But the reason why we draw it on the other side is because we understand, look, protected low, never got ran. Protected low, never got ran. Protected low, never got ran. Protected low, and if it continues, never got ran. So we understood that we have highs and lows within the market. What did we say in the beginning of this? There's liquidity above every single high and low. So there was liquidity above this high, there was liquidity above this high. Currently there is liquidity above this high, okay, and we can draw that if you want, with available liquidity with a sideways trend line like such. But we cannot draw on a trend line like this, because the liquidity above these highs have already been taken. So the valid liquidity to draw on at present for this would be this, okay, because we have a protected low that had never been ran, a protected low that had never been ran, a protected low that had never been ran. So there is liquidity below this low, below this low, and below this low, because they have yet to be ran. So we can draw this on as valid liquidity, because the liquidity below them lows have not been taken. Whereas when we look at this, we can see we have this high, and this high. This high liquidity got ran following the break of structure. We target the liquidity above and below the weak highs and lows. So when we got this break of structure and put in this new higher high, we swept the liquidity above this high because we broke past it, okay? So now this is not valid liquidity because it's been broken past. Same thing here, a new higher high, higher low before a higher high. We've put in a new higher high. The liquidity above this high has already been taken. So we cannot draw this sideways trend line as valid liquidity because this isn't available liquidity. Like so, because it's already been run. So you can draw liquidity like this because the currently liquidity is available above this high because it has yet to be ran. But also the liquidity in the trend line is available like this because all these lows have yet to be ran. So we can draw on that as valid liquidity. Same thing vice versa. We can see in the bearish market, we can see protected high was once, protected high, protected high. These all ran highs, okay? We can see that these mitigations basically create and generate this liquidity. And we understand that we cannot draw this trend line. Because why? Because this low, put in a new lower low, as price pulls back, what's the expectation of a bearish market? To put in a new lower low. What are we doing like we explained before? We are targeting to take the liquidity below the weak low, okay? So we understand that this then becomes a target, okay? So we understand now that these lows are being ran because we are targeting the liquidity below the weak lows in a bearish market. So once prices come and put in a new lower low, price pulls back and then it puts in a new lower low, we understand that when we get this break of structure, now the liquidity below this low has been taken. same thing again, break a structure. The liquidity below this low has not been taken. So we cannot draw this as valid trendline liquidity because the liquidity below these lows have already been taken. So once again, if this was to pull back slightly like so, we could then identify this low here as valid available liquidity because there is still liquidity below this low because it has yet to be ran. But we cannot draw that one as available liquidity because the liquidity below these lows have already been ran. So you can see here that this is how we draw the valid trendline liquidity because these protected highs or what once protected highs have yet to be ran because that's what you see in a bullish market where the lows continuously don't get ran. So the lows remain protected, that generates liquidity, and it's the same thing when you get a bearish market. We understood the highs were protected, these protected highs generate this trendline liquidity, and this is available liquidity because these have yet to be ran, and then these lows were always weak. We understand in a bearish market the lows are weak. We target the liquidity below these weak lows, so these continuously got ran once the lows got taken. So this is how you draw valid trendline liquidity when you're bullish and obviously bearish. So we understand now from understanding weak highs and lows, we call it weak because what we're doing is we're taking the liquidity above these highs in a bullish market, and in a bearish market we're taking the lows. So there is no valid liquidity at these lows or at these highs. So I hope that makes sense. What we're going to do now is just take it over to the charts to understand it, to really just identify these liquidities. Like I said, we're not going to understand and draw on exactly how we draw them. How we actually implement them into our strategy just yet. We're going to learn how to identify them first, and then what we're going to do is then from there, then take it and understand when we come to supply and demand, how we actually come to implement them into our strategy.